In this video, we are going to talk about top 10 best investing advice you will ever hear. So before starting this video, please press the like button, and subscribe to our channel for future updates. The toughest part for many people is taking the first steps and getting started with investing. There is apprehension and doubt. Then there's the fear of the unknown. There's a belief that millions of other people know better than you do and that you'll be exploited. At the same time, you recognize the importance of getting started. You are aware that beginning to invest early is the most effective way to accumulate capital over time. Word of Wisdom is here to give you the top 10 best pieces of advice when it comes to investing. So let's get started. Number 10. Invest in what you already know. As Warren Buffett said it himself, never invest in a business you cannot understand. Getting involved in unnecessarily complicated investments is one of the best ways to make a huge avoidable error. The key here is that you need to understand what you are doing and what you are investing in. Many of us have spent our entire professional lives employed in just a few different sectors. We probably have a good understanding of how these markets operate, and who the best companies in the room are. The vast majority of publicly traded firms, on the other hand, operate in sectors in which we have little to no direct experience. This isn't to say we shouldn't participate in these sectors of the economy, but we should proceed with caution. The rule here is to stick to what you understand and know. Number 9. Keep a long-term perspective. Investing requires making informed decisions based on things that have yet to happen. Past data can indicate things to come, but it's never guaranteed. While large short-term profits can often entice market neophytes, long-term investing is essential to greater success. And while active trading short-term trading can make money, this involves greater risk than buy-and-hold strategies. This brings us to the next advice. Number 8. When you buy a stock, plan to hold it forever. How long should a high-quality company be owned after it has been bought at a fair price? In addition, high-quality companies generate high returns and grow in value over time. Fundamentals can take years to have an effect on a stock's price, so only the most diligent investors profit. Finally, investment returns are harmed by trading activity. Taxes and trading fees eat away at returns as you're constantly buying and selling stocks. Instead, we would be better off buying right and sitting tight. Number 7. Set an investing budget. Before you decide what to invest in, you need to decide how much you can afford to invest. Try to build a 6-month emergency fund that you keep in a bank account or CD. That helps you avoid losing money because you won't have to sell investments when they're down if you encounter an unexpected expense. Once you're ready for an emergency, try to invest about 15% of your pre-tax income, though you may need to aim higher if you're getting a late start. Number 6. Most news is noise, not news. Most of the TV and media's news stories are written with this in order to pique our interest and rouse our emotions to get us to action, so we can do something. The stock market is in motion, as it is always changing. We must exercise extreme caution when selecting news to act on, for there are plenty of bad facts out there. As far as we're concerned, this is one of the most important piece of investment advice. Number 5. Invest in S&P 500 index funds. An S&P 500 index fund is one of the most surefire ways to build wealth. Rather than picking which stocks you want to invest in, you'll automatically invest in 500 US large-cap companies that have to meet stringent criteria to be listed in the S&P 500 index. Some of its biggest names include Apple, Amazon, Microsoft, JP Morgan Chase, Johnson & Johnson, and most recently Tesla. A $10,000 investment in the S&P 500 at the beginning of 2001 would be worth around $43,500 today. Number 4. Get started as early as possible. Investing in your 20s is challenging because these typically aren't your high-earning years. But making the sacrifice to invest early will have big rewards. If you invest $500 a month and earn 8% annual returns starting at 30, you'll have $745,000 by the time you're 60. But if you start at 25, you'll have nearly $1.15 million by 60. That doesn't mean it's too late if you didn't get started early on. But the longer you wait, the more you'll need to invest. Number 3. The best moves are usually boring. Investing in the stock market is not a fast way to become wealthy. If anything, we assume the stock market is better suited to gradually increasing our current resources over time. Investing isn't supposed to be fun, and dividend growth investing in particular is a safe bet. Investing in businesses that have already demonstrated their worth is always preferable to trying to find the next big winner in an emerging market. There's no need to try to please someone with our investments or try to be a hero. Boring can be attractive. Number 2. Avoid individual stocks if you don't want to do research. Individual stocks can help you earn even better returns than those S&P 500 funds we mentioned earlier. But there is a catch. Avoid picking stocks unless you're actually willing to research them. If you chase big returns by investing in the latest hot stock, you're likely to overpay. Investing in dirt cheap stocks priced at a couple of dollars or less is a bad move no matter what your level of experience. Those stocks are usually cheap because the company that issues them is in trouble or they've never been profitable. Your risk of losing your entire investment is incredibly high. Number 1. Only listen to those you know and trust. One should exercise extreme caution when it comes to the formation of business relationships and the appointment of managers. The price they put on future actions can make or break their investment over the next years. While we don't have the necessary resources to do a complete analysis of a public company's CEO, or their skill, we do have the ability to choose who we pay attention to when it comes to the management of our portfolios and who we select our investments. Don't be greedy in your investment decisions. All investors seek a good return on their money, but dividends aren't sought after by everyone, and no one cares about your offspring more than you. Which advice are you going to follow from now on? Let us know in the comment section below. If you enjoy this video and want more videos from Word of Wisdom, be sure to hit that subscribe button before you go. Thanks for watching.